On this video, I'm going to talk about where you should leverage using stocks. So on a previous video, I spoke about Lombard loans and some of the positive and negatives of those particular loans. And today I'm going to go in a bit more detail about where you should actually leverage using stocks. So for people who don't know, leveraging using stocks is just a fancy way of saying debt. And basically it works in a different way to a mortgage, but the same principles in some ways apply. So for example, if you've got $100,000 or pounds in your account and your broker gives you an extra 50,000 and they charge you a 3% interest rate, they can do that because they've got the collateral. In other words, they can sell off your assets if something happens and the market goes down a lot. And basically this kind of gets me on to some of the positives and negatives really, because obviously as that example shows, there are several risks of using leverage to buy stocks, because let's use that example again, £100,000 or dollars or euros or whatever, and now you've got 150,000 because you're leveraging, you're using debt. On many occasions historically, the stock market has gone down by 20 or 30%. Occasionally the stock market goes down 50%, but it does happen every so many years. So for example, from 2000 until 2002, 2008 and 2020, there were 50% drops. Yes, they always recovered, but there was 50% drops. But when it comes to individual stocks, drops of much higher than 50% are regularly seen. So one thing I would say is, unless you're a professional investor, I don't think anyone should use margin when it comes to things like individual stocks or crypto. Even very well-known individual stocks like Coca-Cola, it's just too risky for most people, because even if you leverage against a company like Coca-Cola, let's say there's a scandal, something like New Coke, the scandal from the 80s, if something like, well, not a scandal, but it was like a debacle. If something like that happens, or BP with the oil spill or whatever, again, you could be facing a massive margin call, which is when your loan or the amount that you owe to the brokerage is higher than you can repay. That's one thing. Another thing is, obviously, if you're leveraging in different currencies, let's say your main account is in the US dollar or pound or vice versa, and you're getting a Lombard loan or another kind of loan in euros, obviously that's another risk. However, having said that, obviously if somebody would have bought the S&P 500 or a major index years ago, they would have made an absolute fortune leveraging. The S&P 500 has done 11% per year on average since 1945, and that's unleveraged. Yes, it's including dividend reinvestment. Yes, it doesn't factor in inflation, because adjusted for inflation, that 11% becomes more like 7 point something percent. But the point is, that's the unleveraged return. If you would have leveraged it up, obviously you would have made a lot of money. But here's the problem. Even investments that have had 100, 200 year track records like the US stock market, there are considerable time periods where they go down or stay the same. So for example, the S&P 500, yes, it's done 11% per year on average since 1945. Yes, it's averaged 10% per year over most kind of 30 to 35 year time horizons, but that doesn't mean it always does that. So for example, from 1965 until 1982, it pretty much gave 0%. But from 1960 to 1990, it gave about 10%. Likewise, from 2000 until 2010, it was pretty much stagnant. And 2010 to 2020, it did much better than 11% per year. So the point is, these are just averages. You're going to have to be very patient in many situations. And most people are not going to be willing to be that patient. If you start to leverage yourself up, even if you don't leverage yourself up, many people can't deal with the kind of volatility of the market. But if you leverage yourself up, it's going to be even more painful, because you're going to be a bit scared maybe when the market is down. That's one thing. And in addition to that, it's about controlling your risk, right? As I said before. So the way I would look at leverage when it comes to stocks is, you can use it, but you should only use it if you're investing in the indexes or the ETFs. And secondly, you're either a professional investor or someone who has absolute balls of steel. In other words, you're not going to panic if the market goes down. You're not going to also get too greedy. If the leverage starts to work, you're not going to over leverage yourself. So basically, if you've got the right emotional background, you can make it work, but you always have to have some margin of error as well, because look at what's happening now. Interest rates are going up a lot. That means the cost of the loans will go up a lot. The same as with properties, right? You don't want to keep leveraging yourself, because the same thing can happen as happened in 2008. I know some people who are even very wealthy in property, professional property management people in some cases. And some of them actually went bankrupt after 2008 because they over-leveraged themselves, they over-expanded. That meant that when the credit crunch happened, they had to sell off property to pay people like suppliers and people like that. So again, you always have to be careful with leverage, both in real estate and when it comes to stocks. It is true if it's used carefully and with some thought, and you've got the right emotional kind of balance to all these things, it can work. Likewise, if you're well established, like you've got a very secure job or you've got a very secure business, yes, you can leverage yourself more than somebody who doesn't have that. If you're younger, you can leverage yourself more than somebody who's 70. So for example, if you're, say, a 35-year-old business person who has had, you know, an 8-year track record of consistent profits in business, and, you know, you've got cash aside and, you know, you're in a position to leverage, obviously you're in a safer position than if you're 70, right? So obviously use common sense, that's what I'm saying. But the point is, as the saying goes, common sense is not very common. And so many times people allow emotions to kind of get in the way of these things. And that happens with unleveraged investments. But with leveraged investments, it's essential that you really keep your emotions tightly controlled and you don't get too greedy and you don't get too fearful as well. Okay, everyone, go over to adamfire.com if you're an expat or a high net worth individual in particular, and have a great day.